Can you beat the market maker? Stay tuned, traders. We're going to talk about that next. Good day, traders. I'm Stacey Burke from Stacey Burke Trading. It's Friday, the end of another trading filled week. Lots of great moves on all the different pairs, some huge moves on a couple of the days. We've got some specific things to look at with gold. But today we're going to be talking about, can you beat the market maker? A lot of this stuff that I cover on the YouTube channel. And before we go there, I just want to say again, thank you to everybody for a lot of great feedback. Thank you for a ton of comments, emails. I'm just 30, 40 emails a day, so pardon me for being slow to respond, but I'm just getting a lot of material coming in all at once each day. But again, thank you, and thank you for hitting the notifications button, and hopefully you're getting value from the channel. But today we're going to be talking about, can you beat the market maker? A lot of traders transitioning or looking at things differently than the standard technical analysis, courses, books, all the stuff that's out there, and looking at things or trying to look at things from the side of the market maker, the electronic market maker, the algorithms, the big banks, the smart money, whatever you want to call them. They can be beaten, and there is a method to piggybacking on their trades. Today we're going to go through the breakdown of each one of these steps and look at each unit and tear it apart and explain some of the rationale and understanding how to beat the market maker. And people have said to me, well, you don't need to worry about beating the market maker. You can just, the markets have been trending, you can just get in and all that. Well, my response to that is this: if you're not beating the market maker, they're beating you, because it's you against them. So if you are not beating them, you're not beating me. You're not trading against me. You're trading against the smart money. That's that movement on the screen, the other side of your trade leverage, the liquidity provider, the person taking the opposite side of your position is indeed the market maker. Whether that is your broker, your liquidity provider, it all trickles back down to the same source from the big funnel up above. If you haven't seen Anton Kreil's video about the whole industry works, Google it. A fantastic video breaking down everything right down to even the free education that you can get online. So today, can you beat the market maker? Understanding that especially the electronic market makers, they're like playing chess against the computer. Every single move is calculated into their model based on human behavior, based on how people think, based on their emotional response to price movement, the speed of movement, the spreads flashing, all these little things that happen, and they happen at very specific times, at very specific levels in the market to entice us either into the wrong direction or to scare us out of getting into the right trade at the right time in the right direction with as much size as possible, because of where it's at, where it's located. The highest amount of fear is at that level unless you understand all the things we're going to break down and go into today. So you're trading one of the pairs and just following your system. It's a trend trade and it's going to swing again. You get into the market, it's going to go down. It looks like it should just blow through the floor or through the roof, and all of a sudden the next bar starts to print against you. And you think, okay, well, I'll give it a bit more space. It hasn't hit my stop. The next bar prints against you. And then you watch that market move 25 or 50 pips or more, if it's gold, in the other direction. And you can't understand why or how that happened. You're checking your news feed, you're looking online at Bloomberg or CNN, and you can't find anything on the news calendar, and it doesn't make sense. Why did that happen? The reason why that happens is that the market will trap volume and drag it in a certain direction, maybe for 3 hours, maybe for 3 levels of price movement, 25, 25, 25, maybe for further than that. We'll talk about that in a second. But at specific times, they'll lock that in and reverse the market which flies in the complete contrast to everything that looks rational in terms of how price should be behaving because it's a trend. And the reason why that is because now they're going back to clear out the money and hit stops and drag traders in the other direction, stopping traders out for losses or less profit than they might have had. They've got this big massive profit sitting there. They put a trailing stop in, they come back later and they've been stopped out with a third of what they had when they were already gone out shopping for their new car. So today let's review and talk about how this works and just understanding that it is us against them. They're there. If we haven't looked at the 10K filings on Goldman Sachs, Google it. Go look at their forex profit ledgers for the last 10 years. They average several $1,000,000 a day in profit. That profit comes from other traders. Understand that you're competing against the brightest, the smartest, the best educated, the best equipped. They've spent hundreds of millions of dollars developing algorithms to take people's money, to outsmart the retail trader, to trap them into the market and get them convinced that they can win this game if they just work a little bit harder at it. Just give it a little bit more time, put more money back into the account and keep doing it and then repeating the same things over and over again. When the penny drops and you realize that unless you have addressed so many different factors to be able to compete against the electronic market makers, again the banks, banks are 70% of the volume I think at a minimum in the market. They are there to take our money. When you start to put the dots together and understand this on every level, you realize that they will get your money unless you start to address every little detail and scale it back and stop trading until you know exactly what you're looking for. You might have a day where you get a great trend trade and you figure it out and the EMA crossovers and the stochastic worked perfect, and then the next day level 3 you're getting chopped everywhere, you're jumping in, you're getting mad, you're revenge trading, you're anger trading, you double up, you triple up, you average into a losing trade only to find out that you're going the wrong way at the top of the week before the market drops all the way back down to the beginning of where it started. Little things like that. So we talk about the high of the day and the low of the day. The market maker works at the top and the bottom. So I talk about 50 pip boxes. We could be double zeros, 25, 50. It could be any numbers we want. We're going to talk about that in a second. It could be a 25 pip box. I want you to start thinking about the box as the actual spread. So I'm not talking about your buy-sell spread, but the market maker works up here, top and bottom. So we had some specific examples that we're going to go over on the pound Aussie and the pound. I keep talking about prices in a box. So let's say the high is up here and the low is, let's say the low is down here. Okay, the market maker buys here and sells here. Okay, it could be a trending market, but they're still going to sell here and buy here. They get people selling into an uptrend, or they get people buying. They might have started buying here. They buy it up, they pull it back, they buy it up, they pull it back, and they explosive move maybe from here through to 2 more levels. They will buy and sell back and forth in any type of market. That's what gets other traders into the market. So we look at the 15-minute charts. Okay, and this I'm going to explain something about the timing window and shorter time frames. If you're going to be selling at the high, it doesn't matter if you're on a 1 minute, a 5 minute, or a 15 minute. You might get a better fill on the 1 minute. In a lot of cases you will. But if that 15-minute candle is at the high and it's going to be a sell, okay, it's going to be a sell on all 3 time frames. So if that market is going to go 25 to 50 pips the other way, 1, 5, 30 second, whatever, it doesn't matter. Now my recommendation is to use the 15-minute charts primarily because that usually establishes the best levels for the day, for the week, but also most of these rotations, whether it's 1 minute, 5 minute, 15 minute, it takes that 15 minutes on a 1 minute to put the high in place. So if you go up there, we talked about this the other day, it might be a 3 push pattern on the 1 minute. Okay, but that still will take 15 minutes. So we talk about the high and the low of the day. I don't have my green marker yet, but again, these are where stops are. So traders get caught chasing swings inside. Okay, and again, coming back to timings, we're going to go a bit more in depth to understand this. And then at the end of an hour, maybe the beginning of an hour, all of a sudden they'll go bang, bang, bang to the high. Again, flying in the face of everything technically that seems normal. This volume is caught inside. They might have been shorting it up here. They've been shorting it down. They're short up here. They're waiting, they're waiting, they're waiting. The market has reversed. And all of a sudden, bang, it goes back up and hits your stop for break even, for a loss, whatever that may be. But also, they're getting people now buying this up move up at the high of the day. The timing window, 8 to 11 p.m. for Asia, 2 to 5 a.m. for Europe and London, and 8 to 11 a.m. for New York. That's New York Eastern Standard Time. So coming back to the high and the low of the day, if I am not at the high or the low, it better be a trend trade if I am trading inside of this market, inside of that high and low. And what I mean by that, and we're going to look at again some specific examples on the pound and pound Aussie, a lot of emails about where they would have got in. If you are inside of a weekly high low or a previous day's high and low, you either trade off the high and the low of the current day when the signals present, if they present, or you are trading back to the other side in line with the trend. We talk about the three things that markets do. They break out, they pull back, and they trend. They break out, they pull back, and they reverse with false break. And they break out, they pull back, and they go into a trading range, back and forth, back and forth. That could be a 50 pip box. Level 3, trading range, back and forth. They hit both sides, they hit both sides. They go to the high, they go to the low, they go back to the high, they go to the low, they go back to the high again before shifting away. So the high and the low of the day, when you're inside, when the next window kicks in, specifically in that equities hour, they will take traders to the extreme. Usually in that first half an hour, they'll go back up in that first or second candle to the high or to the low of the day, getting traders chasing the move into the low or the high, into that extreme, and then all of a sudden, bang, another candle reverses and they lock in the low or the high. So traders are talking about trading in the gap times and everything else, which is fine, because sometimes there are high and low trades. I will trade them if there is a setup at the high or the low of the day or the week. Specifically, we get that sometimes just outside of the 12 candle window, but sometimes we'll get that just prior to the US Open or just after the London 3-hour window. They'll just extend it down. And again, coming back to understanding the stop hunt. Each session. So the other day on gold, we saw an example. A lot of traders missed the creeping trend down. They broke out. They pulled it back on the previous day's high just prior to the Europe-London window. Anytime you see a creeping trend, go back and watch the video on creeping trends. They will resolve themselves in one of two ways. My mentor, Bill McLaren, one of my mentors, Bill McLaren, taught me that. They will blow off in the direction of the trend, or that's a squeeze for an explosive move up. We've been in a 1, 2, 3 days of strong rise off the lows in a down market in gold. That market went vertical. When did it go vertical? It went vertical in that first hour. Stop hunt trap. That next level, 25 to 50 pips above the Asian high. It stopped at the 50 pip extension, 25 pips above the double zeros on the first candle of the equities hour. So again, timing window. The timings are what's so important. Understanding that when that equity hour starts, that middle hour, they're either now, they've obviously gone vertical. So the beginning of that session has put a low in place. They've gone vertical. So now we're expecting that London potentially could be putting a high of the day in place. They dropped it down and engulfed that high candle. Sideways, they dropped it down in 3 pushes into the US Open. Boom, explosive move vertical again. So again, creeping trends, timings, 3 pushes, 1, 2, 3. So round numbers, we're looking usually at 00 100 pip boxes, especially on gold, but the market can still move off of 50s and double zeros. I saw something recently, a trader said that 3 levels of rise is ridiculous. This market had 7 legs. Count the number boxes, 300 pips, 100, 200, 300. It might have had 10 legs in there, but it was 3 100 pip boxes, 3 levels of rise, boom, boom. And then the timing window. So it's very important. If you want to beat the market maker, pay attention to the clock. These algorithms will kick in right in these 12 candle windows. Huge strong trend. Big market, you don't even know where you're going to get in. Think equities hour, trapping traders in the wrong direction, especially if that first hour continues with the move. So 15-minute rotations. 15-minute rotations. In those 12 candles, we have 3 hours. So if the first hour goes vertical, now we're thinking second hour potentially may be putting a high of the day in place. The equities hour may take traders back against the trend, but before that hour ends, into that third hour, they still may give us our second leg. Remember, once we have a high or a low in place, that is now our reference point, not necessarily an entry point. When we get a blow off on a vertical market at the high or low of the week, we can get 2-bar reversals, but typically they'll retest it with a second leg or a second move into that trade. Little things to think about. All the things that will scare traders out of taking positions in the right direction. So again, round numbers. These 25 and 75 number boxes will typically be where an extended stop hunt will occur either above a level or below a level, trapping volume on the last level before they shift it away. So again, think squeeze, 3 hours, 3 pushes, and boom, an explosive move pulling away. If it's a trend trade, they may drag it down 75 pips away from the high or the low before locking it in into the next session and going vertical again. Trapping volume. So stop hunts typically will be in 3 legs. It can be a 1, 2, 3 on the 15-minute chart. It can be 3 levels, 25, 25, 25. So it may be a 50 pip box, and that third box is where they put a peak formation, high or low in, when the market's reversing or locking it in just prior to the next 12 candle window. Or it can occur in that 12 candle window. 3 pushes, okay, that can occur on any time frame. We can get it on 1-minute charts, we can get it on 15-minute charts. Typically on a level 3 we'll get 3 pushes into a peak, but we'll get those on squeezes. We'll get 3 pushes jamming into a level at the beginning of a 12 candle window. They'll work one level for 3 hours or up to 3 hours, jamming them in for the squeeze and an explosive move in the other direction. But paying attention to understanding each session. If they go outside of a range from the previous session, whether it be the US, Asia, London, typically you can expect, if it doesn't fail at that high or low, that they will go at least 25 or 50 pips. Now if it's a trending market, that market may move 75 or more. That market could move 150 as we saw in gold. We are not talking about counter trending a trending market. We're talking about when a market goes vertical on a stop hunt. But what tells us that? The timing window. If they go and hit the stops in that first hour, now we're thinking middle hour. So if the middle hour, if it's a trend trade, the middle hour will stop hunt back against the trend into where the breakout occurred for the continuation. If they're putting a peak formation in, that equity or middle hour will typically form the peak. So we saw this week, we saw market extend down on the pound Aussie pound. They extended it down, they pulled it up and rolled it over. There was no evidence of a bottom being put in place. Plus, we were still inside of the previous day's low that they hit on the pound Aussie. They hit the previous day's low, and they continue to extend the range. So if they continue to extend the range, be thinking 25 to 50 pips. You're still going to get a move back as we saw in the US session, but go back in 25 and 50 pip increments and be thinking next session. So 3 levels, understand that can be 75, 50, 300 pips, depending on the day, depending on the instrument. Just to reinforce, 99% of these trades will come off numbers once the stops have been hit at the higher low of the day. So we can get a market that goes vertical, as we've seen on gold. Even though that market has been going up for 3 days, that is still considered a stop hunt into the huge move that came down. They're going back to get the money back from traders who are holding on to those short positions, who have been in massive profits, which we're going to talk about in a second, maybe not taking it off, whatever that may be. But the move back vertical is still going back into a down leg. Peak formations. What gives us our high and our low of the day? I want to see an engulfment, and the pin hammer usually will accompany it in most cases on any time frame. That's the pin up into the traders who are in the right direction. So they've shorted the market on an engulfment, possibly on an M or a peak formation blow off in that second candle of the equities hour. Then the pin goes up in there one more time as a stop hunt against traders who are in the right trade before dropping away or pulling away off the bottom. We'll see that in a lot of cases on the W's as well. That little pin hammer after they lock in an engulfment, that's the second, just a grab at the cash after they've locked in that peak formation low. That's what I need to see. If I don't see that, they're not done yet. They're going to go, they may go sideways for 3 pushes before they lock it in, but until I see them lock that in, I'm not even looking at that market. I need to see them lock it in with the engulfment. That's what says they're done doing business at that level. How do I manage the trade? Well, if I'm in this trade, I should be able to be at break even within 45 minutes to an hour, and if I haven't already taken profit, or I should be in profit. That's 3 bars. 3 bars, even if they go sideways. So again, we've had some examples on the peak formation, 33 high of the week where they went sideways under that third leg for an hour. That is a little bit different. We're at the high of the week. They've gone sideways after 3 pushes. I would still hold on to that trade. But in most circumstances, after we've had 3 pushes and we've entered the market, usually those markets will move in a fast, explosive move. Now again, coming off a peak formation high or low of the week, if it's gone vertical, they still will usually be up 25 pips minimum within that 45 minutes. But if I'm not, and that market's still sitting there and it's not behaving properly, and it should have blown off or moved fast or moved quickly, I'll either be cutting the trade. Even if it goes, I don't care. I have a rule about certain things, and I'm quite prepared to walk away from a trade and not get anything if it's not behaving the way it should. If I expect an explosive fast move after a 3 push pattern and that market hangs around or comes back, I'll be cutting that trade, moving on to the next trade, or waiting till the next session. I'm not here. My number 1 rule is don't lose money. They've gotten enough money from me in the past, and my number 1 rule now is don't lose money, and I'm getting it back. So I don't sit around and wait. When these markets are supposed to move and move quickly, I'm cutting the trade. Otherwise, I'm at break even. And I told this before, if a market gets to the low or high of the day or to a level and hangs around for more than 30 minutes without taking out my profit target, I'll take whatever's there, 35, 40, 45, whatever that may be. I'm not going to hold out for that extra 5 pips, because the next candle could pop up 15, 20 pips, and all of a sudden I'm sitting with a 15 pip profit as opposed to 40. So I'm religious about cutting the trade and taking the money. Learn to take a profit. Another thing Bill McLaren talked about and taught me, and took me a long time to learn, and I program all my profit targets into my platform. I want them taking me out when they're moving fast through a level. I do not want to second guess. I don't want to hold on for more. 25 and 50, unless it's a measured move and I've got a second position in, which I don't often do, but I am taking something off the table every single trade. I make sure of that. You need to get paid for performance. And remember, it's better, even if you get 10, that's better in your pocket than giving them nothing, than getting nothing. So again, 45 minutes to an hour. To be honest, in most of these trades, I like to see a fairly strong move within the first 15 to 30 minutes in my favor, and moving to a level. So it may move to a level through a high or low, but that may still be the middle structure printing. And I'll let it come back, but after that third candle, I should usually be able to be at break even or the market behaving as it's supposed to. 1 bar stop. So again, you might be filled on the 4th bar at the high or the low, but if you're locking it in at the high, it's the high. That's a 1 bar stop. 1 ATR, 15, 20, 25 pips. Sometimes the candles might be a bit bigger, but remember, we talked about this the other day. Don't get caught on just because there's a pin to the high does not mean that is a trade. That will often be defining the upper boundary or the lower boundary. But unless there's an engulfment accompanying that pin as a second leg, so again, we could get the pin first and then the engulfment, or we can get the engulfment and then the pin, but we need a second leg. A pin by itself, unless it's on a blow off in that equities hour, so they've extended it out another 25 pips and gone 1, 2, 3 and ended on a pin off double zeros or off 50, whatever that may be, then I will consider taking the trade. But 25 pips above the box or 50 pips without any other confirmation is not a trade by itself in that first hour specifically. So again, that 1 bar stop. That 1 bar stop might be the bar might be bigger, but usually when they've locked it in with that engulfment, you can safely assume that your risk is controlled by that 1 bar if you've got all these other factors in place. And again, profit target 25, 50, 75 to 100 pips. Sometimes I've got a couple different models, but usually 50 pips when we've extended our box. So our low of the day might be 75 pips away and they're locking it in that upper quarter. I know I've got at least 50 pips to the low of the day. So again, we talked about doing the math of where the high and the low are, how far apart they are, and then in your head knowing that if they're going higher, so they've moved it 25 pips above the Asian range, how far am I from the low of the day? So am I 25, am I 50? If they're up around the 50 level, they could go 25 below. So now we could get a trade in there somewhere and it's still 25, 50 pips below the low of the day. But when they get to the low or the high of the day, if they don't blow through that level, then I'm looking at that level now as a potential reversal area before, even if there's a move later, but I will lock in that profit. So, and again, that all depends on where you're at in the weekly and daily template. So again, if you're inside of the highs and lows of a previous day, you can expect a previous day's level, high or low, to become potential support or resistance for your trade. If you're in a weekly template, are we up high? Have you had 3 days up? We had 1 day down on gold and 3 days up. Third day of the month, 1, 2, 3. We may get a big move today. We'll talk about that on the daily chart. So again, thinking, where am I at in the last few days? Did they move it down and then move it sideways for 3 days? 3 pushes down low. We could still get a measured move. All those little things, because you might be shorting a market rolling over. You want to get out at the low of the day, but it's a 150 pip measured move down like we saw in gold or more. So looking at where you're at in the daily template, when you have the opportunity to squeeze more out of a winning trade, you need to know and have a plan going into each session of when and how that can present and how you're going to trade it, how you're going to manage it, how you're going to take profits off the table, how you're going to manage your risk. All very important. So again, can you beat the market maker? If you address all these things, and remember, they work outside, no matter where you're at. Work outside of the 25 pip. It could be a 50 pip high-low they're working, but remember, stay outside. Your box could be 50 pips. Doesn't matter. Stay outside of the numbers. If you're in here, you're caught inside. They are working off the extremes. If they're not here yet, you need to wait because they're going to go. If the high's up here or even in here, the high of the day could be right in here. Okay? The low of the day might be down here. They are going to get there at one point or another. They are going to go there. We didn't get too much into peak formations at the beginning of the day, but understanding also that each one of those sessions potentially will lock in a high or a low for the day. So if a market goes sideways, chances are that it's not the high or the low, as we see in Asia a lot of times. But if a market moves and puts a high in place, or vertically down low, gives us a peak formation low, and we're down low for the week, or in a trend, that may be the low of the day. So the next session may be in the middle of the move unless it goes vertical and gives us a peak formation for that session, locking in the high until we get into the next 12 candle window. Little things to think about. We'll look at the charts. We'll take a look at the last few days. Some huge moves this week, some fantastic opportunities, end the week on a strong note. Do everything to the best of your ability, and just again reinforcing, work from the top and the bottom. This is where the market maker traps everybody. They work out here, whether it's 25, 50, 100 pip boxes, they work on the outside. So if you have a buy level down here, wait. This is your strike zone. Same thing up here. Thank you again for a ton of great feedback. Stay disciplined, stay focused. You can beat the market maker. Have a great weekend. Have a great trading session today and the week on a strong note, and may the markets go with you.
Good day, traders. Stacey Burke from Stacey Burke Trading, continuing our discussion on can you beat the market maker. So we're looking at gold on Wednesday, and just again going back to our premise of understanding there's a high and low heading into each session. The market in the rollover gives us a low of the day. We know there are traders in the money from the end of the US 12 candle window where they've gone long. So always looking at who's in profit. And we can see that traders traded the engulfment, the continuation. We'll just open this up. But again, the market had trended strongly on Tuesday, big day, continued into the close before going sideways, before dropping down, putting a low of the day in place, then coming up in two pushes, hitting the high, for dropping down and going sideways and dropping out of the box. So again, we talk about the timing window. That first hour was a stop onto the high of the day, inside bar, sideways, and a 25 to 50 pip move down through the low. Again, coming back into traders who were in the money from the previous night's U.S. session. But also taking note, we see the markets coming from the previous night's high. We have one level of drop, two levels of drop, and then a third level of drop in the gap time, and a 3-bar reversal with a pin hammer engulfment of the low bear. So again, coming back to some fundamental concepts, they're working the low of the day. They're working the low of the day, and they give us a engulfment and a pin hammer together as we just heading into that last hour of the Asian session. Now we've had a strong move. They've done the stop hunt. We're inside. When we're inside of the high and the low, so the previous day's high and we have a low of the day, we trade back in line with the trend. So again, they've put a peak formation low in place. We have a peak formation high from the previous day's session. The market drops 3 levels, and again, just counting the pip levels, roughly 75 to 100 pips. So 1, 2, 3 before going sideways in that third level. Engulfment pin hammer, 1, 2, 3 up, and then a 1, 2, 3 down. Again, just as we head into the open of the Europe London 12 candle window, and a bull pin hammer tweezers beside this in the second candle. Again, the market breaks out through the high of the day, below the previous day's high before pulling back. And again, this is really important to understand that when they don't take out the previous day's high and they consolidate up near there, be prepared for a potentially explosive move. When they just go through the high and pull back, that can continue on for a trend trade. But when they build up and do not take it out, as we see on the equities hour candle at the London Open, the second candle, when they go up and pull back, this is potentially now going to be an explosive move. And as we see, that market just blew off and continued that strong move again. Now you can see that there was a bigger structure, bigger rectangle in place from that whole sideways consolidation. We had 3 pushes down against the up move, staying up in that upper box, coming off of double zeros, again, that lower quarter, getting traders chasing that, what they perceive to potentially be a follow through. If you had moving averages, all that, they'd be dragging you down. It's a down move, it's rolling over, and then boom, it reverses at the timings and then explodes through as we head into the London window. So again, counting the candles, understanding first hour, they give you the last candle of the first hour is a little bullpen up to high, but it hasn't taken, you're still inside of the previous day's high and low. So we've got a low of the day now, they've locked that in, but we're still inside. They haven't taken out the high of the day. We're in a trend. The market gets this little bull candle, and then the first candle of the London hour gets traders shorting this market. Now, we still haven't had a stop hunt. So again, understanding that there's traders that are short with stops above the previous night's session, and then boom. So if you lifted your stop, didn't use a stop, averaged into a loser, this market went vertical. And again, the last candle of our London hour, again, they go sideways and then engulfment. And again, traders, this by itself is not a trade. That is just now demarcating potentially that this could be the high of the day. And the next candle, which again, they just boom, they hit it again. And then boom, a third time. So again, recognizing one push, two pushes, three pushes to the high of the day. Now, in this particular case, gold obviously had a massive move the day before. So we'll go back and we'll look at this because we talked about markets moving in 3 levels of rise. And we can see that the market moved in 100, 200, 300 pip plus increments. So again, when this market goes vertical, it may go 100 pips as our 25 to 50 pip move. This market indeed did go more than 100. It went 150 roughly. And it's 3 pushes. So again, 50, 50, and 50. 3 levels of rise. So this first level clears out almost 100 pips. But again, we see a 50 pip, a 50 pip, and then based on the timings, so we've gone 150 pips, and then we get our 1, 2, 3 inside bar. Again, an example of when a market can be traded off of a 2-bar or 3-bar reversal. Again, this first one, we've gone vertical, but see, we're now in the equities hour. So the first hour is inside. The equities hour breaks out. This is, at this stage, a breakout now. It is not a stop hunt. It is, but we're in a breakout mode. So we put a high in place. They hit it again. They hit it a third time. And now we have double zeros. They've pinned up into that upper quarter. We've got our inside bar for our sell signal back down. So again, understanding that you're shorting a vertical market only because there's an engulfment when what we need to see is them work the high and fail and roll over. They extended it out again and then gave us our inside bar and the engulfment, not only of the inside bar, but the high bull. And again, coming back for 50 pips or more, back in 3 pushes into the U.S. Open. Again, 1, 2, and 3 pushes in our equities hour. Last candle, we get our 2-bar reversal, then the breakout, and the stop hunt back up to the traders who shorted the high of the London breakout. So again, understanding that nobody gets a free lunch. They've come down in 3 pushes, 3 pins on the bottom. They've gotten traders who were in the breakout trade. Then they've gone vertical, getting traders up here. Timing windows, number levels, 3 pushes. All of this it's all there, round numbers, but it was a breakout of the previous day's high and a pullback in 3 pushes. 1, 2, 3 for the continuation up above the U.S. session high at the open of the 12 candle window before we went into consolidation. We can expect possibly similar because again they've pulled it up and gone sideways rather than peak formations and reversing. The next day we head into our 12 candle window. We have 3 pushes into a high. We get 3 pushes into a low before they engulf and reverse. And again, 25 pips below the round numbers before coming back and exploding up through the high of the day. And again, another example of a creeping trend. Creeping trend. 1 push, 2 push, 3 pushes. Creeping trends will resolve themselves in one of two ways. They will blow off in the direction of the trend, so they could have blown off vertical down low. But in this particular case, the creeping trend was against a strong move, and the stop hunt was vertical. The blow off was vertical. And again, 1 push, 2 pushes, 3 pushes down, vertical move again in line with the trend. 3 pushes against the strong move, vertical. 1 push, 2 push, 3 pushes against the strong move, and not so much a vertical, but 3 pushes back to the high. So start counting these pushes. 1 push, 2 push, 3 pushes, 75 pips, 3 levels of drop, 25, 25, 25, getting traders who were long before we get the engulfment after the pin. So again, an example, traders going long on the pin bar, on the second leg, the pin defines the boundary, then we get our engulfment. For the move back up, and we have our lower middle structure for our W, so we need the middle structure. Traders ask, what do you mean by that? That's the middle. The middle on our third leg, in between our second and third leg, that gives us our M or our W and our confirmation bias for our move back up to the high. The market goes in 3 pushes, 75 pips, back to the high of the day before engulfing, dropping down, consolidating, and dropping down again towards the lows. You'll notice that this market gave 50 pips before pulling back and pinning up into the high. And again, an example of first hour taking traders stop hunting and taking them short. So still a trade. We had the engulfment of the stop after the stop hunt, engulfment, trading down 50 pips stop hunt down to traders who were long in the gap time before coming back 1-2 pin to the high, and again round numbers for the 100 plus pip stop hunt back down through the low of the day. So again, just asking yourself who's in the money. And then we see a reversal, pin through the low on a third leg, 1 push, 2 pushes, 3 pushes down, inside bar, pin round numbers after taking out the stops. It's always important after taking out the stops. Engulfments for a 100 plus pip move back up. So tons of trades on gold this week. And again, just marking off 1 push, 2 pushes, 1, 2, 3 inside bar, engulfment, boom, back up. And here we are today. This is, we had 1, 2, 3 days of rise, Tuesday, Wednesday, Thursday on gold. We'll look at that on the daily chart. We've taken out yesterday's high already. They've dropped it down and gone sideways inside after a little micro W bottom in Asia. So again, interesting. We can see them work this high and possibly have a move back down towards yesterday's low, or we could see gold continue its strong movement. But so far we've seen 3 pushes. We got 1 push, 2 pushes, and possibly a third push already in place. We'll have to watch how this behaves. Gold could be an interesting day today. So when we look at the daily chart on gold, obviously a big move. We had stops hit from not only the original breakout back beginning of July. They've obviously pinned through that. We also had stops hit from that breakout a few months earlier, and then they've come V-bottom and then gone 1, 2, 3 at the first of the month. So a potential stop hunt pattern. We could see possibly even at least a revisit of yesterday's low. But if this market breaks back up into that upper boundary, we could see this market continue its strong rise back up and possibly targeting traders who were short at the beginning of last week. So interesting day possibly ahead for gold. A couple of interesting days on the British pound. And again, some examples of looking at each day and knowing that you're inside of the high and the low of the week. So again, we look at each day as a box, but also the week as the week evolves the box. And these boundaries are significant in that we could be selling high or buying low, or if we're inside, we want to make sure we're working from the extremes and either trading with the trend or selling high and buying low. So we look at Wednesday and we see that the market had given us a high of the day and gone sideways. You will see this pattern over and over again. We've gone through this before. They trap volume in this upper quarter above the double zeros, consolidation sideways, 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 and then in the beginning of the session, sometimes in Asia, they'll do this. They hit the stops of that consolidation. So again, triggering breakout orders, possibly long, chasing the move long, and then the fast reversal. This big bar scares traders out of taking this trade. But again, an example where we've talked about after a big bar, you can still use these levels as reference. So again, we're looking at numbers. The market has a big move, shifting away from volume. Our first potential target is going to be the low, not only of the day, but the lows of the last profitable trade. So we see breakout traders were in at these levels. You can see the market hitting these stops, but also looking at this every time the market pulls back, giving us a chance to enter at the numbers and having a 1 bar stop. So if we were to redraw our box, we get a big candle, we get a high above this bar, and the market comes down we're into our equities hour and pulls back. We now have a low of our day. So we redraw our box. Again, you're looking for something down low for the stop hunt back up, but we do not see that eventuate. So we redraw our highs and lows. We get an engulfment of the high bull. So we get a breakout trade, which again, selling the low on a break. We cannot sell or buy the lows of a breakout bar, low of the day. So we wait, but we get an engulfment. But also what we have is 3 pushes against the move down. 1 push, 2 pushes, 3 pushes, and then this third leg we get 1, 2, 3. So again, asking yourself if you are shorting this market. Well, number one, if you're looking for a long trade, well, there's no long evidence of any long. They put the pins in, but you'll notice again, the pins do not give us any confirmation of a trade. We don't get an engulfment. We don't get a middle structure. When the pin prints in the middle, we still don't have evidence of what looks normal for a reversal long. What we're getting is a market that's trapping long traders. So again, we have our high bull. They go sideways, 3 pushes, and eventually break away. Traders who shorted that, again, targeting the previous low of the day. So again, we're going back down to the low of the week. The low of the box, we're inside. We want to trade back in the direction back to the extreme. Once they break that extreme, and now we're looking for something going the other way. The U.S. session, we get a low of the day put in place just prior to the U.S. session. They come back in our 12 candle window and they hit the low 3, 4 times before giving us a pin bar inside, but also a bar with a middle structure. They engulf it, and the market pulls away. So again, no evidence of a bottom in here, but we're inside. We're inside, but also coming back to some basic concepts. Just looking at even measured moves. We take the low before the market broke out. We're looking at expansions of this range. The market broke through the second level and consolidated. So we're expecting at least another possible expansion or test of the previous day's low. 1, 2, 3 back up against the trend in our 12 candle window. Trap, stop hunt in 1 before going vertical in our equities hour, pinning the bottom in the third candle of the equities hour, consolidating and then engulfing that whole lower structure. Again, understand when this bar engulfs, it's trapping over an hour of volume underneath. They've locked in the low of the day, 1 bar stop, the market pulls away. So coming back to this, we see the market pull away. It also prints above our stop hunt low, possibly giving us a reversal from the low of the week. The market goes sideways into consolidation. We can draw our boundaries on the pin hammer. So again, pins can become flip zones. Every time you see a pin and they break one side, you can now look at that possibly for a measured move as a flip zone. They give us our geometry. They break out in Asia before continuing higher. This market is now in a breakout mode, and we're heading back towards the previous day's high. So we do not want to counter trend the peak formation. This is a market that is in breakout mode. We're in trend. So traders are trying to short this, and they're shorting the trend. We're trending back towards the other side. This is the day where trend traders, with their indicators in that, stay always in long. So the market gets into our 12 candle window, they put a high of the day, they hit it again. Traders are looking for a sell signal in an upward trending market. You'll notice as well that it layers around the double zeros. They hit it again, we're making new highs. They pull back inside, traders are shorting this still. They come up inside again a third time with a lower high before finally breaking through. 2-bar reversal engulfment, 1-bar stop for the continuation of that move. So again, even just coming back to some basic concepts on a measured move, we measure the bottom rectangle, the bottom structure, and we can have a minimum target of the previous day's high. We're inside the box. We stay in line with if this market's moving to the other side of the box, as we did. This market broke out though. It broke out of a range, so we trade in line with the trend back to the extreme. The market broke out and was trending. We stay in line with the trend. So we come back to some basic understandings again. Peak formation low. Asia goes into a consolidation. Gives us a bit of a V bottom before continuing. This could be the low of the day. We have a peak formation. We trade in line with the peak formation. The market puts a high in place. They extend the high. They pull it back, consolidate, extend the high again. We are now in a trend. 3 pushes against the trend. 2-bar reversal again. Continuation. That market continued its move through the high. Pin hammer through the high. The pin traps traders wanting to short this. Again, all by itself. No two-leg structure. We're in the gap time, and they reverse the pin hammer right off the bat. So again, that can become a flip zone. The market goes sideways before breaking out in our 12 candle window. And our equities hour gives us a 3-bar stop hunt. Again, a 3-bar stop hunt in our equities hour against a strong trend. So breakout, pullback, continuation. But what we did see yesterday, which is very interesting, is 3 peaks, 1 push, 2 push, 3 pushes. Possibly could be a consolidation market heading for either a breakout back up through this level and continuing back through the high, or this market stays sideways and breaks down and we get a big move back down towards the low of the week. Time will tell, but we're sideways underneath the peak formation. So as of now, we have 3 peaks. The market is consolidated underneath, and we are underneath of that U.S. session blow-off. So very important to pay attention to how the pound goes today. We could see some big moves as we head into our London and U.S. sessions. Just revisiting the pound Aussie again, reviewing. They broke through the low of the day. And again, understanding when they break through the low of the day, how we can get 3 pushes back into that lower range. 3 pushes into our 12 candle window, and the market continues to pull away in the direction of the trend. If they had layered on top of the previous day's low, that would be different. But they put pins through, again, attracting traders wanting to go long, but no evidence of a long trade in that 4-bar pattern before breaking through and then working into the previous day's low. Study this pattern. The pin gave us a lower boundary. The market extended that. They broke it, and then they worked into the previous day's low before pulling away. Next day, again, Asia, they break out, they hit stops. Consolidate and drop down below the high bull candle before reversing and stop hunting first hour back down to the low of the day. A little bullpen hammer at the end of our first hour. The first candle of London engulfs, bullpen, breakout, pullback. Last candle of the equities hour is a doji, and then our first candle of our third hour is a bull candle that breaks the high of the doji. When you have a doji, whatever side gets broken is critical, but we have the breakout pullback continuation, and we have our shortened W pattern. So again, stop hunt was to the low of the day. It stopped on a dime at the low of the day. There's our structure. We could target probably a one measured move of this range, which the market gave us. So again, high, low, came down in 3 pushes. 1 push, 2 push, 3 pushes blowing off. A little bull candle at the end of our hour. The first candle of our London hour pins into it and engulfs. It's a 1 bar stop. Regardless if you traded down here, first candle of London, or the first candle of the 3rd hour, it's a 1 bar stop. Market breaks through the high of the day and continues for the measured move. And again, as we head into today's session, we have 3 pushes ending our US session, but again, this market could break back up through here and head towards yesterday's high, or we could see 3 pushes as we're sort of seeing right now, and possibly a revisit down towards the low of the US session. But if this market breaks up through this level, we could see a little bit of a breakout pullback and a continuation back up long, or the market rolls over 3 peaks and possibly revisits yesterday's low. Hopefully you got some value from today's video, traders. Stay to the outside. Okay, we talked about this. The market makers work on the outside, the highs and lows. Timings are critical. 15-minute rotations of these hours, depending on how price behaves. We want to look for the engulfments and pin hammers after they've done the stop hunt. If the market does not give us that, we wait, because as we saw this week on a couple of pairs, they could be extending that range. They may be continuing for a move towards the high of the week, the low of the week, the previous day's high, whatever that may be, but we work from the highs and the lows. We don't get in front of a moving market. We want to trade in line with the dealer. Keep it simple, traders. Have a great trading session, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.